Hello, traders. Black Dollar Ambrose speaking. Good morning, good afternoon, good evening, depending on your location or your country. Yeah, today I'm making this video purposely to show you guys something about liquidity and structure, liquidity and market structure. But before that, I want to discuss something about price action. I'm not a price action trader, though I trade some bits, something. I get something little from there and I incorporate it into my trading way. So there are some mistakes I normally see price action traders make, and it would be better if could maybe try to show something or how I would approach it if I was a price action trader, the way I would approach the market, the price action way if I were a price action trader. So let's say you're a price action trader, which is maybe a trend line trader. Let's say you have your trend line trader. Let's say you have your first touch, second touch, and you're looking for entries. Your trend line should be at the tip of the candlestick, at the tip of the candlestick. Then the other one, the next touch should be a line of best fit. Our next touch should be a line of best fit. Like here, it should be a line of best fit and it should rest on the candlestick body but not cutting the candlestick body. The first one is on the tip, the other one should be resting on the candlestick body. Like this one should be resting on the candlestick body, like this. So that is our trend line. So let's say you're looking for entries. Entries is normally on the third touch. So this is your entry, and also you're looking for entries here. So this is H1. If since I'm a day trader, I would go to minute 5. Since I'm a day trader, I would go to minute 5. So I have minute 5 there. A lot of price action traders, what they do is they just wait for candlestick confirmations, the shooting stars, the haramis, the engulfing candles, the bearish engulfing, bullish engulfing, tweezer tops, those ones, the marabuzos. They just wait for it once price, like here, if you are to zoom out critically, you can see that price gave something here like this. Price gave something. This is a confirmation. We also have here a shooting star. We have a lot of confirmations here. But the way I would approach it is I would wait for structure shift. I would wait for the structure to shift. Like let's say we have, remove this. I'd wait for a structure to shift after price taps on that point of it. Let's say now this is what we have. This is a high. Then we can see some bend here, some pivot. This is a higher low. Then we see a break of this. This is a higher high. Then we see this level failed to hold. It failed to hold. Then it came to the downside. So now it has broken, it has confirmed that the market is bearish. So I wait for a mitigation of this zone 50% and I enter 50% of this zone. I enter, then I dive to the downside. That's why even you have seen the market going to the downside. So I just pull out my Fibonacci tool. I like a Fibonacci so much. Fibonacci tool until the lowest point like this. I look for my discounted zone. I mean premium pricing. Sorry, premium pricing. Premium pricing, which is here, which is around here. Then I remove this Fibonacci tool. Then I look for some imbalances at least, because I see a lot of imbalances, displacements. Banks are coming in. Then I see this candlestick, which is a supply zone. Here, I would enter from here. I put my stop loss above. I put my stop loss above here or here, depending on your risk appetite. Then I dive to the downside. So that would be my entry, and you can see how it worked out. Zero drawdown, it worked out. So on the second, on this other second tap, on this other second tap, I go to the 5 minute. I go to the 5 minute. I wait for the market to tap. This was a tap here. So let me clear everything here. This was a tap. Now we are looking for another entry. Clear everything. So let's observe the price action that is being printed there. Let's observe the price action. We see we have a high, we have a higher low. This one never broke, though it wicked, but never broke. So we have a higher high. Then you see the market came, and broke this. You see it came and broke. Having broken it, it mitigated our zones. Then after it dropped. That was this. This is how you can get zero drawdown trades on this. I feel so bad when I see a price action trader entering a trade, then it goes into lots and lots of drawdown. Then after his target is 1 to 2 risk to reward RR, multiple errors. Because you will see that the market will tap this, then it will give you all the confirmations. Then after it will take you out in case you're using candlestick confirmations. But once you wait for the market to shift, it will be very hard for the market to go back to that direction again. So that is how I would approach if I was a trendline trader. Then if I were a support and resistance trader, if I were a support and resistance trader, let's look for zones. This is a first tap, second tap. So let's say if we are plotting it, we put it at the body of the candle, the lowest body. You see this? So I elongate it until here. I don't cut the body of the candle. I don't cut the body of the candle. Then I mark this. Are you seeing? This one wasn't cut. So one touch, the second touch. Then I take it until this side. Then this our lower part has to rest on the wick of the candle. Then this upper one rest on the body of the candle. Then I put it here like this. Now here, if I were a support and resistance trader, yeah, I were a support and resistance trader, but sometime back in 2018, that was when I was a support and resistance trader. 2017, 2018, price action trader, but I advanced a bit. So you see, here, now here we have the mark first tap, second tap, the third tap. So here we see the market came and broke this trend line to the down. I mean, this support and resistance, this support to the downside. The market broke it to the downside. So having broken it to the downside, what comes into your mind? What you do is you look for an immediate break of structure that happened. Because we can see here, we can see the market was, we had from here, we had this. No. Pull my polyline here. We had this. We had this rapid move to the downside. This. Then the immediate break was this. This level was broken to the downside. So what you do is you don't just enter immediately. Like here, people would have lost a lot of the people who use candlestick confirmations would have lost a lot of money, and they would have also tried to enter from here. But what we do is, you after this break like this, I look for these imbalances. I'm in love with imbalances, insufficiency, and FVGs, fair value gaps. This is the imbalance. Shows that the banks are coming in. Displacements. Are you seeing these rapid bearish candles to the downside? Then I mark the candlestick that is above to be my supply. It's as simple as that. Then after having marked it, I wait for price. I wait for price to tap on it like this. Then having when price taps on it, I go to minute 5. I go to minute 5. Then I look for the confirmations. I don't just enter blindly. I look for the confirmations that is needed or that we need for price to drop. So here, price, this is a high, higher low, higher high. This is a higher high. Then a break of this. You can see a break of this to the downside here. An aggressive trader would enter immediately, price closes here like this candlestick closure, he would enter. But if you're a conservative trader, you wait for the retracement. Then after, you dive to the downside. This is a waiting game. A lot of people will fail to wait because they fail in this trading industry because they are not able to wait. So you can see how you would have caught this setup. You would have caught this setup from around somewhere here, because I see we have a zone here. So you'd have caught it from somewhere here and dropped with it until here. It's a good move. A good move, yes. That is how a trend line, a support and resistance trader would attack the market. So the thing is, when you talk of liquidity, so let's say we have 2 points. We have this point and we have this point. And the market is playing between two points, this 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 and this. What you have to know is that liquidity is everywhere. We have liquidity above here, we have liquidity resting here for the people who are selling. Then we also have liquidity resting here here for the people who are buying. Normally when you join the industry, you are told to buy low and sell high. But the question is, how low is the low and how high is the high? There is no high in the market and there is no low in the market. Everything is low and everything is high. So how high is the high and how low is the low? That is the question. So buy low, sell high. But me, I can mean to do the opposite. I can mean to sell low and buy high. You get? I can mean to sell low and buy high. What I'm trying to mean is, what I'm trying to mean is, a lot of people will put their stop losses here. But for me, stop losses will be resting here. Stop losses will be resting here. These are stop losses for the people who are selling, and these are also stop losses for the people who are buying. People are buying here, putting their stop losses here, buying here, stop losses here, buy here, stop loss here, sell here, stop loss, sell here, stop loss, sell here, stop loss here, sell here, stop loss here. So now people are selling high and buying low, selling high. But me, I can mean to buy high and sell low. What am I trying to mean? Normally, I wait for the stop losses of the people who buy low or sell high to be taken out before I can enter. Because I see there are a lot of stop losses here. Because now imagine we have a market that is here like this. We have a market here like this. Then the market drops. Because for you, you're seeing your buy low, sell high here. Then there's a level that the market is observing here. There's a level that the market is observing here. So you here, you're being acted as liquidity. You and your zones here, buy low and your sell high thing, you're acting as liquidity. So me, I wait for that liquidity to be taken out, and then the market taps on an institutional level above here, then I sell. Let's say an institutional FU, institutional candle, or demand zone, supply zone, depending on the structure you're following. So I would wait for me to sell. For me to sell, I'll be like, if your stop loss is taken out, you remind me so that I can enter. Once your stop loss is taken out, you remind me so that I can enter my sales. So here you will sell from here. Me, I'll wait for your stop losses to be hit. Then I will enter from above my zones here. Then I will sell, targeting the stop losses also below here, like this. So there are only three things that the market does. The market does only three things. That's what you have to understand. Our points of interest does not matter. What the market does is, the market is ever generating liquidity. The market, that's the first one. The market is ever seeking liquidity. That's the second one. The third one is that the market is ever rebalancing inefficiency. Three things. Listen well. Three things. The market is ever generating liquidity. The first, the market is ever seeking liquidity. The second, the market is ever rebalancing inefficiency. That is the third thing. That's what the market is ever doing. The market does not care about our points of interest. Our points of interest, we just use it as a confluence, So here, your stop losses would be taken. Reason being, this one can act as Asian liquidity, the Frankfurt and the Tokyo session liquidity, all those things. So the market will seek for it. The market will generate it. Will generate it after it will seek for it and take it out. Then after it will rebalance itself. That's what the market does. Liquidity and structure. People say structure is more important than liquidity, but me, I say liquidity is more important than structure. Structure, liquidity is the king and structure is the queen. Liquidity is very important. Liquidity is like the fuel. You cannot drive when you haven't fueled your car. You cannot drive when you haven't fueled your car. So let's talk a bit of structure. We have a higher high, higher low, higher high, higher low, higher high. So let's say we have another higher low here and the market gives a higher high. Remember, this is your market structure. We have the market has reacted at a point of interest here. This is our point of interest. Time is running out. This is also another point of interest of ours down. So this is a break of structure. This is another break of structure. This is another break of structure. So what we see is the market reacted on this point of interest and went up. It left a point of interest below and it went up. So there's a difference between you see this area, we have this area, unmitigated zone. So this is unmitigated zone. So the area that the market lives and moves to the upside minus mitigating it is what I call, not what we call. It's me. It's what I call a left order. So the market sometimes it will come here, it will induce you, seduce you, do everything to you, induce you, seduce you, bury you and say welcome to the candy show. Then after it gives you something little, then after it will come back to this zone here, this zone below, this left order here like this. Then after it will rise to the upside, continuing with the trend. A lot of people who do not know the liquidity concept will think this is a break of structure, will think this is a break of structure, will think this is a break of structure. Then after they place their entries here, they'll be hit, they'll be taken out, very fast. This is just liquidity. This is just liquidity that the market generated. Liquidity that was generated by the market. And it was taken out by this move, tapped on this point of interest, and it went to the upside. This is what gold did last week. EU also did this. UJ also did this. Most pairs do the same things. In and out. In and out. So basically, liquidity is important, is a very important concept when it comes to the trading industry. I think I've discussed what I wanted to say today. Let's give an example. Let me give a final one. Let's say we have a level. Let's say we have, let me see. Let's say we have a level. I think that will be a topic for next time. Time is running out. Thank you, everyone. It has been me, Black Dollar Ambrose, the CEO of Black Dollar Ambrose Trading Forex Trading Academy. Yeah, this is what we normally do in our academy. We have, in case you haven't understood anything, hit me up in my inbox and we discuss more. More of these videos are coming, but they'll be dropped in my groups, Telegram, WhatsApp, all those social media handles. I think. Thank you. In case you haven't understood anything here, you're free to ask and we share. Have a nice evening. For the Ugandans, And my friends in Nigeria, have a nice day. Nigeria, Kenya, Rwanda, Tanzania, have a nice day.